Paul retired at 54 with about $2 million in liquid assets. He's 68 now. He spent the last 14 years drawing from that money to fund his life. As of last month, when he showed me his quarterly statement on his back patio, his portfolio sits at roughly $2.4 million. He has more money today than he had the day he stopped working, after spending more than $1 million of it. The question I get asked most often on this channel by people in their late 40s and early 50s is some version of, can I do what Paul did? The honest answer is that the math of retiring at 50 with $2 million isn't actually that hard. You can pull the spreadsheets up. You can find the bucket strategies on YouTube. The competitor videos break the portfolio into chunks, calculate the safe withdrawal rates, run a Monte Carlo simulation, and call it done. That's all real. It's also incomplete. The reason Paul still has $2.4 million isn't that he picked the right bucket strategy. It's that he understood there are 3 doors between an early retiree and their own money, and most people only know about one of them. The bucket math is a useful tool for the second decision an early retiree makes. The first decision, the one that actually determines whether your $2 million lasts to 90 or runs out at 75, is which door each dollar comes through and in what order. I'm Tom. I'm going to walk you through the 3 doors, what's behind each of them, how Paul got through them, and why the 2026 landscape just made the second door dramatically harder than it was 4 years ago. This channel is real personal finance for normal people, not the get-rich-quick version. While if you want the real wealth growth, hit subscribe. Before we get into the doors, let me set the math. The headline figure of $120,000 a year of spending from a $2 million portfolio is a 6% withdrawal rate. That's well above the classic 4% rule, which would have you spending $80,000. Paul didn't actually spend $120K every year. He peaked at about $115K in his most active early years, when he was traveling and active, and tapered to around $80K by his late 60s, with Social Security covering a meaningful chunk of that by the end. The average across his 14 years has been just over $100K a year. That's a 5% withdrawal rate on average, which historical research suggests is viable, but tight. Whether it actually works depends almost entirely on which door each of those dollars comes through. Door 1, the 9.5-year access wall. Here's the problem most early retirees discover roughly 6 months after they retire. The IRS does not let you touch your 401k or your IRA without a 10% penalty until you turn 59 and a half. If you retire at 50, that's 9.5 years of zero access to the biggest pile of money you've spent your career building. If you retire at 54, like Paul, it's 5.5 years. Whichever it is, the wall is real, and it's set in federal law. People discover this wall and have one of 3 reactions. The first is to assume there's a loophole that solves it. There are 3 legal exits, but each one has a cost. The second reaction is to pay the 10% penalty and just eat it. That's an enormous tax on your early years, and over a 5-year bridge, it can quietly cost you tens of thousands of dollars. The third reaction, the one Paul took, is to have built the bridge before you retire. Worth knowing all 3 legal exits. The cleanest is a taxable brokerage account, which has no age gate at all. Money you put in there at 40 is available at 50, at 60, at any age you want it. The trade-off is that there's no tax deferral on the way in, so most people overweight their 401k and underweight their taxable brokerage during their working years. By the time they want to retire early, they don't have a bridge. The second exit is your Roth IRA contributions. Not the earnings, just the basis. You can withdraw your original Roth contributions at any age. No tax, no penalty, no questions. The 5-year clock I talked about in the Quiet Assets video applies to earnings, not contributions. So a Roth that's been quietly funded over a long working career becomes a meaningful slush fund during the access wall years. The third exit is the Rule of 72T, formerly called substantially equal periodic payments. Under this provision, the IRS lets you take penalty-free withdrawals from your IRA before 59.5 if you commit to a fixed payment schedule that lasts either 5 years or until you turn 59.5, whichever is longer. Where it gets dangerous is the inflexibility. Once you start, you cannot change the amount for the full duration. If you start at 50 and your situation changes at 55, you cannot stop or adjust. If you do, the IRS retroactively applies the 10% penalty to every distribution you took going back to year 1, with interest. The 72T works, but it's a one-way door. Paul's bridge was the first exit. He had spent his last 15 working years putting his bonus into a taxable brokerage account because he'd already maxed his 401k and his Roth. By the time he retired at 54, he had roughly $700,000 in that taxable account, separate from his $900,000 traditional IRA and $400,000 Roth. That $700,000 was the entire reason he could retire at 54. Without it, he'd have either delayed retirement to 60, paid significant penalties, or been forced into a 72T schedule. The lesson most working people miss is that maxing tax-advantaged accounts is the right move for normal retirement at 65, and the wrong move for early retirement at 50 to 54. If you want to leave the workforce early, you need at least one bridge account that's available immediately. Doesn't have to be huge. It has to be enough to span the gap. Door 2, the 15-year healthcare gap. Medicare doesn't begin until you turn 65. If you retire at 50, you're looking at 15 years of needing to find your own health insurance. For most Americans, that means the ACA marketplace. And as of January 1st, 2026, the rules of that marketplace changed in a way that makes early retirement noticeably harder than it was last year. For the last 4 years, from 2021 through 2025, enhanced premium tax credits passed under the American Rescue Plan and extended under the Inflation Reduction Act removed the income cap on ACA subsidies. You could earn 6 figures in retirement and still get a partial subsidy. The cliff at 400% of the federal poverty level, the one that used to lose you all your subsidies if you went $1 over the line, was effectively abolished for those years. Those enhanced credits expired on December 31st, 2025. As of January, the subsidy cliff is back. For 2026 coverage, that cliff lives at $62,600 of modified adjusted gross income for a single person, or $84,600 for a couple, based on the 2025 federal poverty level numbers the marketplace uses. $1 over that line, and your subsidy goes to zero. The Kaiser Family Foundation calculated that the average ACA enrollee's premium payment more than doubled in 2026 compared with 2025 because of the cliff coming back, with individual premium payments rising by about $1,000 a year on average. This changes the math of early retirement in a way most YouTube content has not caught up with. If you're spending $120,000 a year from your portfolio, and most of that comes out as taxable income, you blow through the 400% FPL line in the first 5 months of the year and lose every dollar of subsidy. Across the 15 years between retirement and Medicare, that can easily cost you $200,000 of avoidable premium spending. The workaround, and the reason Paul's account structure mattered so much, is that not every dollar of spending counts as MAGI for ACA purposes. Withdrawals from a taxable brokerage account count only on the capital gains portion, not the basis. If Paul puts $100 into his brokerage and pulls $100 out, the basis comes out tax-free and ACA invisible. The gains on top, sure, those count, but the bulk of his bridge withdrawals never showed up on his MAGI at all. Roth withdrawals don't count either. Traditional IRA withdrawals count in full. This means an early retiree who structures their accounts correctly can spend $80,000, $100,000, even $120,000 a year, while keeping their MAGI under the 400% FPL line, which preserves their ACA subsidies. An early retiree with everything in a traditional 401k blows past that line the moment they start withdrawing and pays full freight on health insurance for 15 years. Paul's healthcare bill from age 54 to 64 averaged about $6,700 a year. The first two of those years, 2012 and 2013, were pre-ACA and ran around $14,000 each because he had to bridge on Cobra before the marketplace opened in January 2014. Paul's state retiree health benefit would have cost him about $1,400 a month for individual coverage, which was more than the ACA marketplace cost him with his low MAGI. So he went marketplace. From 2014 onward, with his MAGI consistently under $40,000, his marketplace premiums, after subsidies, dropped to roughly $400 a month. A coworker of his who retired at the same time with the same total assets, but had it all in a traditional IRA and was therefore generating high MAGI on every withdrawal, averaged about $16,000 a year for the same coverage years. The difference across 11 years, before Medicare took over for both of them, was roughly $100,000. Same total wealth, same lifestyle, very different healthcare costs because of the wrapper their money sat in. Door 3, the tax arbitrage window. The third door is the one that, if you understand it, generates more value than the first two combined. It's also the one almost nobody plans for because it doesn't feel urgent. Your tax arbitrage window opens the day you retire and slams shut the year you turn 73, when required minimum distributions begin under Secure 2.0 for anyone born between 1951 and 1959. For anyone born in 1960 or later, the RMD age moved to 75 under the same law, so the window is even longer. What sits inside that window is the most flexible tax planning environment of your life. Your working years gave you high income and high marginal tax brackets, which limited what you could do. Your post-RMD years will give you forced distributions from your traditional IRA, pushing you back into higher brackets whether you want to be there or not. The 15 to 23 years in between, depending on when you retire and your birth year, are the only window where you have meaningful control over your taxable income. 3 specific moves are available almost exclusively inside this window. The first is converting traditional IRA money to Roth IRA money at low tax brackets. Paul did roughly $30,000 of Roth conversions every year from age 60 through 64, paying tax on each conversion at the 12% bracket, which lifted about $150,000 of total dollars out of his traditional IRA before RMDs would have pulled them out at higher rates later. The 12% bracket runs to about $49,450 of taxable income for a single filer in 2026, which works perfectly with the kind of low MAGI lifestyle an early retiree on ACA wants to maintain anyway. The second move is capital gains harvesting at the 0% long-term capital gains bracket. For 2026, single filers with taxable income under $49,450 pays 0% on long-term capital gains. Married filing jointly under $98,900. If your taxable brokerage holdings have appreciated, you can sell them, lock in the gain, immediately rebuy the same securities, and reset your cost basis to current price, no tax owed. This converts unrealized gains into stepped-up basis you'll never pay tax on, even when you sell those shares for real later. Paul did about $25,000 of harvested gains a year across his low-income years and lifted somewhere between $60,000 and $90,000 of lifetime capital gains tax off his balance sheet entirely. The third move is contributing to a Roth IRA if you have any earned income, even from part-time consulting or freelance work. The 2026 Roth IRA contribution limit is $7,500 for under 50, $8,600 if you're 50 or older. An early retiree doing a few hours of consulting a month can quietly tuck another $8,600 a year into a tax-free wrapper for the rest of their life. Here's the catch that makes all three of these moves a real trade-off with Door 2. The income you generate through Roth conversions and capital gains harvesting counts toward your MAGI for ACA purposes. So if you go aggressive on conversions, you blow past the 400% FPL line and lose your healthcare subsidies. If you go aggressive on subsidies, you can't do meaningful conversions. The art of early retirement is balancing these against each other year by year, sometimes leaning toward subsidies in years you have big medical needs, sometimes leaning toward conversions in years you don't. Paul backloaded his conversions to ages 60 through 64, when his ACA trade-off was getting cheaper anyway because Medicare was coming. Step back from the doors and look at how Paul's $2 million was actually structured at the moment he retired at 54. His taxable brokerage account held $700,000. The traditional IRA, rolled over from his old 401k, held $900,000. A Roth IRA he'd been funding since his early 30s held another $400,000. The buckets, in the way the bucket framework would describe them, told you almost nothing about how he was going to live for the next decade. The wrappers told you everything. Years 54 through 59, he lived almost entirely off the taxable brokerage, drawing about $90,000 a year. Capital gains taxes were modest because much of what he sold was basis, not gain. His MAGI stayed under $35,000 most years, which kept his ACA subsidies high and his premiums low. Years 60 through 64, he started layering in small Roth conversions, $30,000 a year, while still drawing his living expenses primarily from taxable. His traditional IRA started shrinking, slowly, at a tax cost of about 12% on each dollar moved. At 65, Medicare kicked in. The ACA trade-off was gone. He could now be more aggressive with traditional IRA withdrawals without losing healthcare subsidies, because Medicare doesn't care about your MAGI the same way. His Social Security started at 67, a few months past his full retirement age, which locked in slightly higher monthly payments through delayed retirement credits. His spending dropped slightly as he traveled less. Across 14 years, he spent roughly $1.4 million in cumulative withdrawals. Despite that drawdown, the portfolio still grew from $2 million to $2.4 million. That's not because returns were extraordinary. The S&P 500 averaged about 7% real over that span, which is roughly its historical average across any given 14-year window. What made the difference is that a wrapper-aware withdrawal sequence avoided about $400,000 of taxes and premium costs that a wrapper-blind sequence would have paid. Year by year, the dollars saved on subsidies and skipped taxes stayed in the portfolio compounding instead of leaking out. If you ran the same scenario for a coworker of Paul's who retired the same year with the same $2 million, but had it all sitting inside a traditional IRA, the same withdrawals would have cost him roughly that $400,000 extra in tax and premium friction. Same returns, same lifestyle, roughly 4/5 of the ending portfolio. That gap isn't market alpha, it's wrapper alpha. That $400,000 is the actual answer to how does $2 million safely fund $120,000 a year of spending in early retirement. It's not buckets, it's not the safe withdrawal rate, it's the wrappers, in the right order, used at the right time. Closing. The bucket framework you see in most retirement content isn't wrong. It's just the second decision an early retiree makes. The first decision, the one that actually determines whether your $2 million lasts 35 years or 25, is which account you draw from in which year, and how you manage your MAGI against the 3 age-based walls that move in front of you. If you're approaching 50 with a portfolio in this range, the audit checklist is short. First, find out what percentage of your money is locked behind the 59.5 wall, because if it's all of it, you don't actually have early retirement as an option without a 72T commitment. Second, look at the 2026 ACA cliff at $62,600 of MAGI single, $84,600 joint, and ask yourself whether your planned withdrawal strategy keeps you below it. Third, count the years between when you retire and when RMDs begin for your birth year. If you're 50 in 2026, you were born around 1976, which means RMDs don't hit until age 75 in 2051. That's a 25-year tax arbitrage window, the longest in modern history. Plan to use every one of those years for either Roth conversions or capital gains harvesting, calibrated against the ACA trade-off each year. If you're in your 40s and just starting to plan, the most important thing you can do is build a taxable brokerage account in parallel with your 401k, even if it means slightly less tax deferral on the way in. The deferral is worth less to you than the optionality of being able to access the money before 59.5. Most early retirement failures aren't math failures, they're optionality failures. Paul didn't get to $2.4 million because he was lucky. He got there because the math behind the doors worked in his favor for 14 straight years. That's available to anyone who plans for it. It's just not what the bucket videos tell you. Tell me in the comments which door surprised you most. I'll read every one. I'll see you in the next video.